Hello everyone and welcome to another video on US taxation. So today we are here to present on salary and wages income, and this is the first head of the income on which we are going to talk in detail. So in the previous chapter we learned the fundamental structure of the US tax system and understood the difference between the gross income and the taxable income. We saw that IRS does not tax everything you earn directly. Instead, income goes through a structured process of adjustments, deductions, and exclusions before we arrive at the taxable income, which is the amount on which tax brackets are applied. But that raises an important question. What type of the income actually makes up to the gross income? Because people earn income in many different ways from the employment, investments, businesses, property, and other sources. The most common and the primary source of the income for millions of taxpayers is salary and the wages. When someone works for an employer, the compensation they receive, whether it is salary, bonus, commission, or certain benefits, become part of their taxable income. However, not every benefit received from an employer is taxed in the same way. Some benefits are fully taxable, some are partially taxable, and some are completely excluded from the income. So in this chapter, we will explore income from the salary and the wages, which forms the foundation of the employment taxation in the United States. We will understand what constitutes salary and wages. We'll also understand different components of the compensation, cash versus the non-cash compensations, taxable and the non-taxable employee benefits, payroll taxes such as Social Security and the Medicare, the withholding tax system, and concept of pay as you earn, and how salary income ultimately translates into taxable income. By the end of this chapter, you will clearly have understanding that how employment income is structured and reported and taxed under the US tax system. So with this, let's move to the agenda slide and see what all we are going to cover as a part of this chapter. Okay, so the key agenda that we are going to cover as a part of this chapter is that we're going to have a look at what is salary and the wages income, complete understanding. We'll also understand the concept of cash versus non-cash compensation. We'll understand employer provided benefit, like whether they're taxable and the non-taxable, and understanding completely under the various block what is the form W-2, which is a kind of a certificate being issued by the employer to the employee. uh, Payroll taxes and the on the salary, like Social Security and the Medicare. Concept of the withholding tax system, which is like pay as you earn concept. Taxable versus non-taxable employee benefits. We'll have a full example to demonstrate that how we'll start from the components of the salary and then how finally we end up paying the taxes, which includes both the federal tax and the payroll taxes. And then we'll also spend some time in understanding what are the some of the tax planning area with respect to the salary income. So we'll move to the first slide. Okay, so what is salary and the wages income? So if we quickly have a look at it, salary and the wages income refers to the compensation received by the employee for services performed for an employer. This is the most common type of the income reported on the form W-2 and is taxed as the ordinary income. So salary is a part of the ordinary income. All the components of the salary are included to calculate the gross income, and then there are some exclusion. Then we'll calculate the tax and pay the tax and reported the employer reported the tax in the form of the withholding tax under the form W. So it includes both the cash components and as well as the non-cash benefits. So if you look at the component of the salary, it has the base salary or the hourly wages. This is the fixed compensation paid regular to the employee performing the job duties, which can be monthly, annual salary, or the hourly wages. So, example, employee annual salary is $80,000. This entire amount is included in the taxable wages. Next component of salary can be the bonuses. Bonuses are additional payment given by the employers based on the performance, company profitability, and the retention incentives. And any kind of the bonus which is being paid to the employee is included as a part of the salary and wages income. So we'll move to the next slide and look at other components as well. Okay, so next component is the commissions. Any kind of commission which is being paid to the employee basis the sales performance of the business generated by the employee, which can be through it can be scenario wherein employee is working the real estate, insurance, or the sales. All these commissions are also included as the part of their salary and wages income. Likewise, any overtime payment is additional pay for the hour work beyond the standard working hours. So any amount which is being received as an overtime is exactly treated as the regular wages and would be added as a part of the normal salary and the wages. So we'll move to the next slide and look at other components now. Okay, next component is tips. So, which means that any kind of the tips which is being received by the employee in a form of incentives or kind of services that they have provided through the restaurants, hospitality, and the taxi services. So, tips received by the employees in the service industry is also taxable wages. So, restaurant employee received salary as 30,000, tips as 12,000, total taxable salary and the wages is 42,000. Severance pay. Severance pay is the compensation paid when employee is terminated. It is fully taxable as the wages income. There are certain non-cash compensation which includes the fringe benefits, and some benefits provided by the employee are considered as the taxable compensation. Example: personal use of the company's cars, gift card, employer paid life insurance above the certain limits. All these portion of the non-cash compensation would be included as the part of the salary and the wages. So employee receive a company car benefit of rupees, let's say $5,000. This amount will be included in the taxable wages. So we'll move to the next slide and look at a few more components, and then we'll have a table to demonstrate the taxability of each of those components. Okay, so now we'll come to the last component, which is the stock-based compensation, which is being received by the employee and which is also included as a part of their salary and wages. So employee may receive a compensation from the stock. Examples include restricted stock units, employee stock purchase plan, and stock option. These are generally taxed when they vest or are exercised. So employee receive RSU over 20,000 when vested. This amount would be treated as the wages income. So we have created a table here. So base salary is taxable, bonus is taxable, commission is taxable, overtime is taxable, tips is taxable, severance pay is taxable, taxable fringe benefit obviously taxable, and then the stock compensation. So salary and wages income include all compensation received for the services performed, whether paid in cash or certain non-cash benefits, which includes the fringe benefits. And most of this income is reported annually on the form number W and is subject to both income tax and the payroll taxes. And we are going to talk about these in the upcoming slides. So we'll move to the next slide. Okay, now we'll spend some time in understanding the two components of the two major buckets, I would say, of salary and the wages. So those are like cash compensation, which is direct payment made in the money, and then non-cash compensation, which includes the fringe benefits. And benefits or the perks provided by the employer instead of the cash, both type may be as taxable depending upon the nature of the benefits. And we'll talk about them in the upcoming slides as well. When we talk about the cash compensation, so cash compensation normally includes the base salary, hourly wages, bonuses, sales commission, overtime payments, cash incentive, tips, and severance pay. While non-cash component largely includes the fringe benefits, like non-cash components refers to the benefits or the perks provided by the employer instead of the cash payments. So these benefits may either be taxable or non-taxable depending on the IRS rule. Uh, Examples are company car, employer providing the housing, stock compensation, employer health insurance, retirement plan contribution, which is 401k, gift card or merchandise, and education assistance. So all these are non-cash components which is being included as a part of the salary income, depending upon the case-to-case basis, and this forms the part of the salary and the wages income. So what we have done, we have created a table here to demonstrate which is being included and which is being excluded. So salary and wages are taxable, bonuses are taxable, commissions are taxable, employer health insurance is not taxable. It's a contribution paid by the employer on behalf of the employee. Retirement plan contribution generally not taxed because this is again a contribution which is being on behalf of the employee. It's being a share which needs to be contributed by the employer, and the equal match needs to be done by the employee as well for both the Medicare as well as the retirement plans as well. And then company car, personal use, yes. Gift card, yes. Certain education benefits, limited exclusion. So typically, all cash components are included as a part of the salary and wages. However, there are certain specific non-cash components, which is like Medicare benefits, employer health insurance benefits, and some contribution to the retirement plans, which are not included as a part of the salary and wages. That is specifically the employer contributions. Okay, so we'll move to the next slide. Okay, now we have understood some of the components which is being contributed by the employer, and these are not taxable in the form of salary in the hands of the employee. We'll quickly understand some of the employer provident fund benefits, which is taxable and the non-taxable, and then we'll see what is being taxable and what is not taxable. So, employers often contribute to the retirement saving plans for the employees. These contributions similar to the provident fund benefit in the other systems and which are designed to support the long-term retirement benefits for the employee. So in the US, most common employer-sponsored retirement plans include 401k plans, 403b plans for non-profit sector, and 457 plan, which is for government employees. Defined benefit pension plan, these contributions can have different tax treatments depending upon the kind of the contribution. And we'll talk about this contribution with the help of the example here. So employee contribution to the retirement plan. Employee may contribute part of their salary to the retirement plans. So traditional 401k contribution is pre-tax. It reduces the current taxable income if it, and this only includes the employee share because employer share is always non-taxable. Taxpayer paid when the money is withdrawn at the retirement. So once we have put the contribution, we get the deduction from the gross income to arrive at the taxable income. This is the employee share. And because this is being benefit which is given to the employee and the lower tax is being paid, so which means that at the time of receipt of the contribution from the relevant fund, the entire amount is taxable. So example is let's say 1 lakh is the salary, contribution is 10,000, taxable salary is 90,000. Then we have a Roth 401k contribution. So this is a contribution is made after tax, so which means that any contribution to this kind of fund is not eligible for the deduction. And because it is not eligible for the deduction, and hence any amount which is received from this contribution is also not taxable. So we'll move to the next slide. Okay, now we have understood the concept of contribution of to the retirement plans by the employee, and we understood that any contribution made by the employee to 401k funds is being deducted from the gross salary to arrive at the taxable salary. Let's look at the treatment of the employer contribution. So employer often matches the employee contribution and it is not taxable when contributed. Tax later at the time of the withdrawal. So employer salary is 80,000, employee contribution 5,000, employer matches 5,000. Total retirement contribution is 10,000, but 5,000 will only be reduced, which is the employee contribution to arrive at the taxable salary. The employer portion would be non-taxable. Taxation at the withdrawal. Withdrawals from the traditional retirement are taxed as the ordinary income tax, which is like let's say somebody has withdrawn 30,000, the entire amount is taxable to the tax. So there is the clause of early withdrawal penalty. So withdrawal before age 59 and a half may trigger the income tax and an additional 10% withdrawal penalty. So early withdrawal of 20,000, which has the income tax plus withdrawal opportunity, withdrawal penalty as well. So if we look at the contribution here, so employee contribution to 401k is uh, not taxable, taxable later, which is the final receipt. Employer match is against not taxable, it is taxable when she received. Contribution, 401k contribution is taxable, Roth is taxable, Roth 401k contribution is taxable now and it is not taxable at the time of receipt. And the retirement withdrawal is taxable if it is a traditional plan. So we'll move to the next slide. Okay, so now we have understood the concept of components of the salary. We understood the major bifurcation of the cash versus non-cash components. We also understood the contribution to the retirement plan and how the treatment is separate for employer contribution versus the employee contribution. Now we'll look at the one of the most important form, which is the form W-2, which is being issued by the employer to the employee, and same is also being filed with the federal authority to the IRS. So Form WT is issued annually by the employers to the employee and the Internal Revenue Services. It reports total wages earned by the employee, taxes withheld during the year, Social Security and the Medicare wages, and the employer provided benefit and the retirement contribution. So employees use this W-2 form to fill their final return, which is Form 1040 of the federal tax. An employer must provide the W-2 form to the employees by January 31 of the following year. So key section of W-2 form is that the first section speaks about the employee and the employer information, which is like box A, wherein employee social security number is being there to identify the employee for social security and the tax reporting. Boxes B and C, employer identification number, employer name and the addresses used by the IRS to identify the employer. Boxes E and F, employees information includes the employee name, address, insurance. So these are like basic information of both the employer and employee to identify the employee through their social security number and likewise for the to the employer with their identification number so that they are IRS is clear that whether the employer has provided all the necessary information and complied with all the formalities. So we'll move to the next slide and see all the relevant blocks of the form W. Okay. Now, so the next section is income and the withholding, wherein box one is speaking about the wages, tips, and the other compensation. So this is the taxable wages income for the federal tax purposes, which includes salary and the wages, bonus, commissions, tips, and all the taxable fringe benefits. So example is the salary is 90,000, bonus is 10,000, box one amount is 1 lakh. Then we'll move to the next box, which is the federal income tax withheld, which shows the total federal tax withheld by the employer during the year. So this amount is credited when filing the tax return. So which is that total federal tax withheld is 18,000. So this is the eligible credit that is available to the to an individual, and that can be claimed as a credit when filing the final return in the form 1040. Social security reporting, which is part of the box 3 and box 4, which includes social security wages subject to the social security tax. These may be different from the box 1 because some benefits are excluded. Example, social security wage cap is 168,600. So which means that there's a capping attached to the social security and a particular portion of the tax which is being deducted depending upon this capping. And likewise, social security tax withheld is 6.2% of the social security wages, which is being withheld by the employee. Social security wages 80,000, tax withheld is 6.2% of 80,000, which is like 4960. We'll move to the next slide and see other components of Form W. Now, box 5 and box 6, when we look at the box 5, it is Medicare wages and tips. Wages subject to the Medicare tax. Unlike Social Security, there is no wage limit for the Medicare reporting. And box 6 includes the Medicare tax withheld, which is 1.45% of the wages. Example, Medicare wages is 1 lakh. So tax withheld is 1 lakh multiplied by 1.45%, which is 1450. Then we have additional compensation and benefits, which includes in the box 10 dependent care benefits, employer reports provided dependent care benefits, and then box 12 additional compensation codes reports various benefits such as 401k contribution, health saving account contribution, group term insurance, such type of the identifying letter code. So all these are being there in the for various places of the box 12 to provide all the relevant information, which includes any kind of the deductions. Then we have box 13, special indicators whether the employee participated in the retirement plan, received statutory employee wages. This box may affect tax reduction because tax deduction depend upon the contribution by the employee to various schemes. So we'll move to the next slide and see the rest of the boxes then. Okay, then we have box 14 on W-2 form, and this is basically is used by the employees to report additional compensation or deduction that are not included in other standard boxes. So basically, this is a placeholder box which includes all the information which is not available in the relevant boxes, which are the specific information which needs to be provided by the employer. So this can accommodate any kind of the deductions or the income components which has not been reported in the other relevant boxes. So IRA does not assign a specific universal category to the box 14. So instead, it allows the employees to report information item that may be used for the employees when preparing to their tax returns. And then we have the state and local tax reporting, which includes box 15 to 20. These boxes report state wages, state tax withheld, local taxes used for filing the state tax return. So this table below demonstrates the complete understanding of various boxes. So box 1, taxable wages; 2, federal income tax held; 3, social security wages, social security tax withheld; 5, medical wages and then medical tax withheld; 10, dependent care benefits; 12, retirement other benefits; 13, retirement participation indicator; and then 14, which is the placeholder; and then finally 15 to 20, which includes the state and local tax information. So this gives us the complete understanding that what all information needs to be provided by the employer while providing the form W-2. So we'll move to the next slide. Okay. Now we'll talk about another important section, which is the payroll taxes, which includes two specific type of taxes, which is Social Security and the Medicare. Now, concept of the payroll taxes are taxes imposed on the employee wages and salaries to fund the federal social insurance program. In the United States, the primary payroll taxes are Social Security tax and the Medicare tax. These taxes are governed under the Federal Insurance Contribution Act, which we normally call as FICA, Federal Insurance Contribution Act. Both the employees and the employer contribute to these taxes. Social Security tax, the purpose is to fund the Social Security program, which provide benefits such as the retirement benefits, disability benefits, survivor benefits. And employee contributes 6.2%. Similar portion is being contributed by the employer. The wage limit is that Social Security tax applies only up to an annual wage cap. Cap for 2024 limit was 1,68,600. Income above this amount is not subject to the Social Security tax. Example, employee salary is 1 lakh, Social Security tax is equal to 6.2% of 1 lakh, which is 6,200. Employer also contributes 6,200. Total contribution is equal to 12,400. So we'll move to the next slide. Okay, now we'll talk about another type of payroll taxes, which is the Medicare tax, and there is no capping applied on the Medicare tax. And they fund the Medicare program, which provide the health insurance for the individuals age 65 and above, and certain disabled individuals. So contribution, employee contribute 1.45%, and employer contribute 1.44%, and total is 2.9%. So there's no wage limit. Unlike Social Security, Medicare tax applies to all wages without any income cap. Employee salary is 1 lakh, Medicare tax is 1450. Employer also pays 1450. And then a total Medicare contribution is 2900. Additional Medicare tax is applicable if you are high income earner. Single is a threshold limit of 2 lakh, married filing jointly is 250,000, and married filing jointly is 1,25,000. And if you have income over above these limits, and if your filing status is single, married filing jointly, and married filing separately, then you are subjected to another 0.9% of tax, which is like additional Medicare tax. And this is the employer rate. Employer do not contribute to this additional rate. So Social Security tax is 6.2%, both employer and employee. Medicare is 1.45%, both employer and employee. And for high wage earners, it is 0.9% additional basis the threshold limit, on which they have to pay the additional Medicare tax. So this, with this, we come to the conceptual understanding of payroll taxes, which includes the Social Security and the Medicare tax. So we move to the next slide. So like in many countries, US also works on the same concept of withholding tax, and they normally call this pay as you earn. So which means that the United States follows pay as you earn, which is PAYE system. So under this system, taxes are collected throughout the year as income is earned rather than waiting until the end of the year. So how withholding tax system works? So employee earn the wages or salary. Employer calculate the applicable taxes based on the employee information. Taxes are withheld from the employee's paycheck. Employer remit the withhold taxes to the IRS and the state authorities, and at the year end, employee filed the form 1040 to reconcile the taxes which is being deducted from his salary and which has been deposited by the employer and filed via W-2 return to the IRS. And once they have this information being available to the IRS, so at the time of 1040 filing, this is shown as a tax credit which will be adjusted, and this will be deducted from the final tax liability to arrive at whether the additional tax needs to be paid or refund is there. So type of the taxes withheld from the salary are federal income tax, social security tax, Medicare tax, state income tax, and the local taxes. Role of Form W-4. So employee completes the Form W-4, which is the employee withholding certificates when starting a job. This form tells the employer filing status, number of the dependent, additional withholding preferences. The information of W-4 determines how much federal tax is withheld from each paycheck. So which means that W-4 is a kind of a declaration which is being filled by the employee to provide that information to the employer with certain set of the information that the employer could able to understand that what percentage of tax will be deducted depending upon the filing status of the employee. So we'll move to the next slide. Okay. So we have demonstrated a quick example here to understand the concept of withholding tax. So employee annual salary is 80,000. Assume taxes withheld in the year is federal income tax, social security tax, and Medicare tax, which is total to somewhere around $16,000 here. So year-end tax filing at the end of the year, employer issues Form W-2 showing the total wages and taxes withheld. When filing the tax return, if withheld taxes exceeds the tax liability, then there's a refund. But if withheld taxes is less than the tax liability, then additional tax needs to be paid by the employee. For example, tax liability is $11,500. Federal tax already held withheld is 12,000. Refund is 500. So key benefit of pay as you earn is prevent the large tax payment at the year end, ensure regular tax collection for the government, reduces the risk of the non-compliances, and obviously makes the tax payment easier for the employees because the burden of the tax is reduced. It's not being imposed on the year end when they have to pay the final tax because they have already paid the taxes via monthly deduction when they get their paychecks, and hence this is being used as a tax credit at the time of the final liability calculation. Okay, now we have understood the concept of the various components. We understood the concept of W-2 form. We understood the concept of withholding tax. Now we'll spend some time in understanding the taxable versus non-taxable employee benefit. So, employee benefits are often the additional benefits to employees beyond their regular salary. These are called fringe benefits. So, it can be taxable and non-taxable. So, taxable employee benefits are cash bonuses, gift cards, personal use of company's car by the employee, employer paid life insurance exceeding 50,000 coverage, housing allowances, non-qualified stock compensation. These are largely a kind of the income which is included as a part of the wages and salaries, even if they are not paid in the cash. And these are normally a kind of a perquisite which is being given to the employee. There are certain non-taxable employee benefits as well, so which is like employer providing health insurance, employer contributing to the retirement plan 401k, health saving account contribution, qualified transportation benefit, dependent care assistance, certain education assistance, and the small benefits like occasional mutual office. So, which means that there are components which are also being given to the employee, but which do not fall in the bracket of the taxable perquisites, and these are normally treated as the non-taxable fringe benefits. So we'll move to the next slide and quickly have a look at the table to understand what are some of the taxable and some of the non-taxable benefits which is being provided by the employer. So here we have done a quick snapshot of what is being included as a part of their taxable and what are not taxable. So cash bonus are taxable, gift cards are taxable, company car personal use taxable, employer health insurance not taxable, retirement plan contribution not taxable, dependent care benefits exclusion, education system exclusion. Likewise, de minimis benefit is not being included as a part of the taxable salary. So with this, we largely covered all the important concept of the income category of salary and the wages. We'll now step into a quick example covering all the aspects and see that how the final tax liability is calculated for salary and the wages income. Okay, so we have taken an example here. Employee name is John, filing status is single. Annual salary package components includes the base salary, performance bonus, commission, gift cards received, employer health insurance contribution, which is something which is being done by the employer, which is non-taxable, and then employer 401k match, which is again not taxable because this is being contributed by the employer. So total compensation packages, total benefit receipts, which includes everything, 153,500, but not all are taxable. So we have to determine the taxable portion of it. So salary is taxable, bonus is taxable, commission is taxable, gift card is taxable. Total taxable wages is 140,500, and this amount appears approximately in box 1 of the form W. So move to the next slide and see rest of the steps. Okay, now we'll look at some of the deductions. So pre-tax payroll deductions. So employee contribution to the retirement plan. So traditional 401k contribution is 10,000, which includes both the employee share as well as the employer share. So which means that the taxable income reduces from the employee contribution will be reduces to get the taxable income. So 140,500 is the gross income. What we have to do, we have to reduce the employee contribution to such plan, which is 5,000. We'll minus this to get the concept of taxable income. So employer retirement contribution increases the total compensation, do not increase the taxable wages, and hence do not appear as reduction. So employee contribution would be deducted to get the final salary on which tax will be calculated. So once we have the portion on which tax will be calculated, we'll apply the percentage of Social Security tax and the Medicare tax, which is 6.2% and 1.45% respectively, to get the Social Security taxes. So we applied 6.2% on 135,500 and likewise 1.45% on 135,500 to get the total payroll taxes of 103,666. This is the total deduction or the total taxes that needs to be paid by the employee. So we'll move to the next slide. And employer also contribute the similar portion to fund these various schemes. We'll move to the next slide. Okay, now we will look at some of the deductions which are available. So assuming that the taxpayer qualify for student loan interest and the health saving account. So this would be adjustment to the incomes. Assume the taxpayers qualify for these adjustments. So this will be adjusted to arrive at the adjusted gross income. So we have arrived at the final adjusted income, which is like 135,500, which is AGI. Then we will minus this 5,000 to get the final AGI. So which has the gross income minus the total adjustments, which includes my AGI, which is like adjusted gross income. And once we have arrived at adjusted gross income, then we'll apply the standard deduction, which is 14,600 depending upon the category of the filer, which is like single here, to arrive at final taxable income, which is 115,900. And on this particular income, we'll apply the bracket to arrive at the federal tax. So we have applied that bracket, and the total tax credit is total federal taxes is 20,858. In the next step, what we have to do once we have arrived the tax here, we will apply the tax credit. So assuming the filer has some credit which is education credit, so which is 1,500, final federal tax is 20,858 minus tax credit, which is like 19,358. So which means that total tax payable is 19,358 plus the two taxes, which is the Social Security tax and the Medicare tax, which would be deducted from their final taxable income to arrive at the final take-home salary. So the total tax to be paid by the employee would be federal income tax of 19,358, Social Security tax of 8,401, and then Medicare tax of 1,965. So net income after taxes is 140,500, which is before the payroll taxes. Total tax paid is 29,724. We reduce that, and then the contribution which employee has to make to the retirement benefit, that will further reduce. The total in-hand salary for the employee would be 105,776. So total compensation is 153,500. W-2 wages is 140,500, which excludes the employer contribution to 401k plan plus insurance benefit plan. Employee contribution is 5,000. This would be reduced 135,500, and then from 135,500 we have to reduce 10,366 and 19,358 to get the final take-home salary. So this is a detailed example demonstrating how wages and salary incomes are included, and then how tax is being calculated. So we move to the next section, which is like some of the tax planning in benefits or tax planning areas with respect to the salary and wages. So move to the next slide. Okay, so some of the area on which tax planning can be done with respect to the salary and wages is, so effective tax planning helps an employee legally reduce the taxable income and the overall tax liability by using the deductions, exclusions, and the tax advantages, benefits provided under the tax system. So what is that? So utilize the pre-tax retirement contribution. So contributing to the employer-sponsored retirement plan 401k can reduce the taxable income, because whatever amount which we are contributing to the to fund that activity, that is actually going to reduce the taxable income on which tax would be calculated. Maximize the employer sponsored benefits. So all the employer sponsored benefits should be maximized, because these are like excluded from the taxable income, because this is not part of the employee taxable income, which includes employer health insurance, employment retirement plan, health saving contribution, the dependent care benefit. Optimize the adjustment to the income. So certain deduction reduce the adjusted gross income, which may also help to qualify the tax credit, like student loan interest, health saving deductions, self-employed retirement plan. So all this would be available, should be availed, so that we have a lower AGI, and then can help to preserve the eligibility of the credits and the deductions. So move to the next slide then. So, individual should be clearly aware of the payroll taxes and the wage limit. So, Social Security tax applies only up to the wage limit, while Medicare applies without any capping. So, income of the Social Security wages is not subject to the 6.2% of the social tax. Income above a particular limit is not applicable for 6.2% Social Security tax. So, utilize available tax credit is like tax credit directly reduce the tax liability, which includes the child tax credit, education credit, earned income tax credit for the eligible taxpayer. Credits are generally more valuable than deduction, because they reduce the tax dollar. So any credits is helping to reduce the tax liability itself, unlike some of the deduction which reduces the adjusted gross income. And then we have to be very much sure that which kind of deduction we should apply for, whether it is standard deduction or itemized deduction. We have covered this concept in detail while we were discussing the gross income and the taxable income. So whichever produces the larger deduction should be used to reduce the taxable income. So retirement plan contribution reduces the taxable income. Employer provided benefit increases the compensation tax effectively. Adjustment to the income will have the lower AGI. Understanding payroll tax limit will help to better tax forecasting. Tax credit help us to direct reduction in the tax liability, and the optimal deduction charge will help us to lower taxable income. So these all opportunities are available when we are doing the tax planning using the salary and the wages income. So with this, we come to the end of this chapter, and then we'll move to the final closing slide. Okay. So with this, we have completed one of the most important income category in the US tax system, which is income from salary and the wages. So in this chapter, we learned that employment income includes more than just monthly paychecks. It can include bonuses, commissions, overtime pays, stock compensation, and even certain fringe benefits. We also saw how salary income is reported through Form W-2, how payroll taxes such as Social Security tax and the Medicare taxes are applied, and how the withholding tax system ensures that taxes are collected throughout the year. So understanding salary taxation is essential because it forms the largest portion of the income for most taxpayers. But employment income is only one part of the overall tax landscape. Many individuals also earn income from the investments such as the bank interest, bonds, and the corporate dividends. These type of incomes follow different tax rules and sometimes different tax rates as compared to the salary income. So in the next chapter, we will move from the earned income to the investment income and specifically focus on the income from the interest and dividends. So we will explore what constitutes interest income. We'll also understand what are the dividend payments, how they are reported to the IRS, and how these type of the incomes are taxed differently from the salary. So understanding the decision is extremely important for the investment planning and the tax efficiency. So we'll have another presentation to cover this chapter. Until then, thank you, goodbye. Subscribe our channel, view this video, and share this video to the maximum audience as you can. Thank you and goodbye.